everyone, welcome back to the Buckingham Breakdown. We've just put the finishing touches on our 2024 market research all the way through Q4. And as you might suspect, things are changing a lot right now, so there's a lot to unpack. It's really interesting. Let's dive in for a deeper look. So first and foremost, transaction volume. This is perhaps the metric that moved the most in the last quarter and throughout the last year, really suggesting a shift in the market. Transactions steadily climbed throughout 2024, ending with 231 transactions in the fourth quarter. That's about a 50% increase from that time last year. So to me, that says that we're starting to see that expectation gap between seller price expectations and buyers' willingness start to narrow. It seems like people generally agree the worst is behind us. Peak interest rates are either here or in the rearview mirror, and perhaps finally pricing's at a level where buyers are thinking, okay, it's time to get off the sidelines. Deals are starting to make sense. Let's see if we can put some capital to work here. Okay, so for pricing, on the surface, things didn't look like they changed too much. We finished the year at about $480 per square foot overall for multifamily in the Greater South Bay, and that boiled down to about $403,000 per door. But diving in, the story starts to change. Again, like we've seen in previous quarters on this cycle, there's a huge difference between what happened in the residential 2 to 4 unit space versus the commercial multifamily 5 unit and above space. The 2 to 4 unit numbers were pretty much flat. They ended at $531 a square foot for the fourth quarter, and price per door was about $462,000. However, for the larger 5+ properties, big change there. They sold for an average of only $368 a square foot. That includes super nice parts of our market area like Manhattan Beach and Redondo Beach, and only $273,000 a door. That's down 20% and 17% respectively from the middle of 2022. So that's a huge change. And so while the pricing metrics had some changes, especially in the 5 and up space, they weren't really all that exciting when we take it into context for the whole year. Seems like not a whole lot happened there. Well, there's a big difference between what we see there and what we see in the income metric scenarios. So when we look at cap rate and GRM, the changes are even more pronounced. Overall, GRMs ended the year at 14.9. So that's a pretty low multiple based on what we've seen over the last 10 years. That goes back to like 2015 at this point. Cap rates ended at about a 4.6%, but again, that includes the 2 to 4 unit properties and the larger 5 and up buildings. 2 to 4 stayed pretty healthy and insulated from these changes in the market and from the impact of the higher interest rates, because we have a lot of owners there that have locked in 30-year mortgages with rates in the 2s, 3s, even 4s. So there's really not a lot of distress in that part of the market. The 5 and up properties are really starting to feel the impact of these rolling, resetting mortgages that were originated in the pandemic when rates were super, super low. We've seen cap rates rise on 5 and up buildings from about 4% in the middle of 2022 all the way up to 5.5%. And we've seen GRMs go down by almost 5 full multiples. That is crazy for 2.5 years. Just to put that into perspective a little bit, if you do the math on 150 basis point increase to cap rates, that results in a pricing discount of almost 30% on the same net income from a building 2.5 years ago. That is huge, and no doubt that's what people are seeing in the market right now, which is starting to make things more attractive for buyers to step back in. We ended the fourth quarter at only 12 times gross across the whole market for GRM and a 5.5% cap rate. So that's starting to look really attractive even with rates pretty high these days. Okay, and another really interesting data set that I was looking at that hasn't been much of a story over the last few years is inventory. So inventory can be a great leading indicator when you're looking at sales in any asset class. It's a good indication of what the market might be doing in the future, because the more supply that there is available for purchase, the less competition that you get for buyers, and you would think that that would have pricing implications. So steadily throughout 24, and really before that 23 as well, we've seen increasing inventory, right? As we have more of these resetting loans, especially in the 5 and up space, and people are less motivated to buy because of higher interest rates, we've slowly watched inventory levels creep up. They've gone from really 10, 15, 20-year lows that we saw in like 2020, 2021 and the pandemic when money was really cheap, up to now, we're starting to get even above our 10-year average, going back to when we were in recovery from the subprime crisis. So it's really interesting to watch that. We've seen inventory go all the way from only about 600 listings at the beginning of the year in January of 24 up to like 700. But then oddly, it came sharply down again at the end of the year. We do monthly inventory metrics. And I think that's because we started to see the macro environment shift in a big way in the middle part of the year. The Fed took their first few rate cuts. The bond market got really excited about that. We started to see investors come back in, sensing a height in rates and perhaps a bottom in pricing. But then we had kind of a 1-2 punch. The election came in November, Donald Trump was elected, and then everything freaked out about tariffs and deportations and labor costs and all this kind of stuff. And so the 10 years jumped back up again. But we had a lot of deals that got into escrow and got snapped up. At the same time, I think there's some optimism out there in the market about just the general business climate, perhaps deregulation, and what that might do for the financial markets. And so we've seen an increased buyer interest as we move here into 2025. And as a result, we've seen inventory just in the last couple of months take a big dive. So maybe we've actually reached an equilibrium here where we'll see inventory kind of flatten out and be in sort of a normal range. It seems like from a pricing standpoint, buyers and sellers kind of agree where we are. If I had to call it, I would say this is probably the bottom, or maybe even the bottom is about 3 months ago in pricing when some of these contracts were first being inked. Great time to jump in if you're a buyer right now and see what you can get going. So what do you make of all this? I know that's a whole bunch of word salad, and I tend to talk way too fast because I get all excited about macro stuff and cap rates and pricing. Well, reading between the lines a little bit, if you have a 1 to 4 unit property, pricing still looks really good there, demand still looks really good. And if you're in a position where maybe you have a lot of equity in that building, we've said this before, this is probably a great time to consider doing that exchange and scaling up your portfolio. You can still get really solid prices for smaller buildings, and it's absolutely a buyer's market in the 5 and up commercial multifamily space. So we're in one of those rare situations where you actually might be able to sell high and buy low and still complete an exchange. On top of that, the IRS, if you're in LA County, has extended 1031 exchange deadlines for many taxpayers. So you may be in a unique window right now in 2025 where you could do a 1031 exchange and have significantly extended time periods to find that replacement property. So if you want to learn a little bit more about that or what we're looking at around the office, there's a lot of great deals out there right now. Give us a call, reach out. We're happy to help.